Hi, you're listening to The Condo Expert. This is Linda Pinizzato, and today at the Hayes FM, we welcome Faisal Jamel. He is a mortgage broker with The Mortgage Edge. So welcome on the show,
Good
Faisal.
morning. Thank you. Thank you for having me.
Excellent. Did you have a great weekend?
I did. It was too short, though. Isn't that always a common issue with weekends? There just isn't enough days.
Oh, absolutely. Well, unless, of course, it's summertime.
Yeah, exactly.
Summertime, it's all good, right?
Always. No doubt about it.
I know. What we're going to talk about today is mortgages. And, as you know, with the condo show, what we try to do is give a lot of people, condo owners, the general public, information about what's going on out there in the condominium world. But interesting enough, mortgages, they go both ways. I mean, if whether or not people are actually living in a condo right now and they need to refinance their mortgage, or they want to take equity out for any given reason, maybe want to go on a trip, get away from the snowstorms.
That's right.
That would work. Maybe you could give us a little bit of a background, like as far as yourself with mortgages.
I've been in the business now for just under 5 years, Linda, and in that short time frame, I've seen the landscape of mortgages change dramatically. It's been unbelievable how many things have changed, and the biggest impact has been last year when the government advised us of these new B20 guidelines, and that's had a significant impact. There were a couple significant changes. Number one, they reduced the amortization to 25 years for insured mortgages. They also reduced how much equity is available under lines of credits. They brought that down from 80% to 65%. The third change was how much you were allowed to refinance your home up to. Previously, when I first got into the industry, it used to be 95%. Now it's been reduced to 80%. And the goal behind all these changes is to help curb debt. So there's been a lot of changes, and those were the last round of changes announced, I think it was just last summer.
So, it's interesting because as you're curbing debt, I guess they're forcing people to have more equity in their homes.
Exactly.
Right,
They wanted people to stop using their homes as ATM machines, were the exact words.
You know what? It is a good point. I mean, I think in the U.S., their whole structure is completely different from us.
Very much so.
So, I remember the times, quite frankly, many years ago, you couldn't even buy without 25% down, and then we had second mortgage lenders coming into the picture and so on. So are you finding that overall, I guess, first-time buyers are tending to go towards condominiums and getting high-ratio mortgages? Is that where the spin-off is coming from?
That's exactly it, Linda. A lot of people still have difficulty saving the 5% down. There's also additional closing costs, which they do not realize, which are typically about 2% of the purchase price of the home. So a lot of people are still having difficulty saving up. And I find that the condo market is a little more affordable for first-time buyers because they don't typically have to save as much as they traditionally would when they're buying a much more expensive home.
Right, exactly. And then you've got, if you think about it with condominiums, you have a number of different types of buyers. You also have your investors. If somebody's purchasing on an investment aptitude and they want to get financing, then they're not looking at high ratio. They're looking at more of a more secured investment going into the home, or maybe you can elaborate.
That's correct. That's one of the changes as well that happened a few years ago. One of the rules now for people buying investment properties is that they're required to put a minimum of 20% down. Now, what's happening with that is even at 20% down, traditionally there is no CMHC fee, as we know, or insurer fee at 20% down. But lenders have their own policies. So if you want to deal with a specific lender, they may or may not charge an insurance premium at 20% down. Some will say you have to put maybe 25% down. So it really varies from lender to lender. And that's just something we have to be cautious of and take into consideration when we decide who are we going to deal with. It's important to have a competitive rate, but it's also important to know what are the other risks and costs associated with dealing with that lender.
Well, the insured part, because you mentioned CMHC. So CMHC, just for the audience, Canada Mortgage and Housing Corporation, we actually had the Ontario economist, Ted Tsiopoulos of CMHC on the radio show last week.
Right.
And giving us a little bit of an inside look into where our economy is and what the different elements are depending on price and how the activity changes and so on. So on a mortgage front, CMHC, being Canada Mortgage and Housing, they will then add a certain amount to the insurance coverages, like of the monthly payments?
That's exactly what happens. So there's a one-time premium that is added to the mortgage. Clients do have the option to pay for that premium up front if they want to, but typically most people will have that added to the mortgage itself, and it can be amortized in 25 or 30 years. Now, there's also a sales tax, which is added to the mortgage as well, and that typically has to be paid when closing at the lawyer's office, and that cannot be included in the mortgage itself.
Right. So when you add all those back up again, exactly, you have to have affordability. So
Exactly.
Without a proper mortgage structure in place and without a proper mortgage broker looking after your interest, it makes it very hard for individuals out there because they really don't understand the system.
That's right. I'll give you an example. I did an investment property for some recent clients, and they were very well-educated clients. They're ready to make the plunge, but they actually did not know that 30-year conventional mortgages were still available. And the benefit to that for them was that this allowed them to reduce the overall mortgage payment and make the property more cash flow positive. And that was a great opportunity. And once I presented that to them, they were head over heels.
So now if we take a look at condominiums, now we've got the mortgages intact, maintenance fees, that's a big one, maintenance fees. I mean, you find that no matter which building you're in, all the maintenance fees can be completely different from one building to the other as far as percentages are concerned.
That's right. So that's one very important planning tool that I have to discuss with my clients is, are they prepared to have the condo fees go up and up and up? And this is something that we need to talk about. If I'm dealing with a single income earner, am I dealing with two incomes? How will the condominium fees or maintenance fees impact that family in the next 5 years? We know their mortgage payment is going to remain fixed. We know their property taxes will have minimal increases, but what we are not certain of are the condominium fees. So this is something I have to talk to my clients and make sure that they have a really solid understanding what will happen if they go higher, if we're dealing with two incomes and one person loses their job. What kind of impact will that have on their family and their financial livelihoods?
Exactly. So for the listeners out there, Faisal Jamel of the Mortgage Edge, this is Linda Pinizzato. You're listening to The Condo Expert. We are getting back into the maintenance fee issues of condominiums. Very important. So stay tuned. We'll be right back.